Okay, good afternoon, guys. Welcome to this one-day special event. We're going to talk about money management, goal and risk-reward ratios today. So, very, very important when we trade the markets. We understand any kind of basic plan that we should have, all to do with, again, risk-reward ratios we need to employ to make sure we're not risking too much. Okay, we need to understand how much we're trying to make. Putting all these things together, putting them into these volatile conditions we're trading right now, and understanding what's the best way to try and make money with the resources we have. So money management is really cash management. There's lots of different terminology for these things. You couldn't be in better hands. I'm not just been a trader for over a decade. I was also risk manager at Revco. So managed some very, very big traders. Also ran one of the biggest trading floors in Europe at Schneider's. So I'm well used to dealing with all sorts of different types of traders, helping them through it. So this presentation today is really just a basic summary. It's too big a topic really to cover in 45 minutes, but I've tried to summarize all the key things that I think you should look at. And once you understand why you need to approach the markets in a certain way, have a certain plan, have a certain way of trading that suits your style, then again, you're going to be a lot more protected with what you're risking for what you can make. And there's a few different tips and techniques I'm going to tell you, especially I would guess in these current volatile markets. I would definitely look at trying to average, starting with smaller size and to negative and to positively build positions in the markets in order to fade out that volatility and also not having to have such very, very tight finite stops. So again, we'll go through as always, guys. Any questions, as always, just ask me, put them through in the chat or the Q&A window. If we get through this in time, and we have enough time at the end, what I'll do is I'll pull some charts up and I will go through some real-time scenarios and tell you what all this really means in the markets right now. So I had a break for a couple of weeks, so I'm tanned, but I'm back, we're ready. So let's go on with the presentation, and any questions as always, guys, let me know. So risk warning, guys, before we start, spread betting, CFD trading carry a high level of risk to your capital, resulting in losses that exceed your initial deposit. May be suitable for everyone, so please ensure you fully understand the risk involved. Information is provided herein under no circumstances are considered an offer or solicitation to invest. Nothing herein should be construed as investment advice. Information provided is believed to be accurate at the date it is produced. Again, education only. Content of the webinar is opinion of the moderator, not intrader.com. Content does not constitute financial, investment or tax advice. Intrader.com does not accept any liability of the content of content during this session. So the key to successful trading. Well, the biggest reason people don't make money trading in the markets is quite simple. The losses are larger than the profits. Sounds obvious, but most traders run losses far more than they do actual profitable trades. It's all psychology. It's all the psychological edge of it. Many a times, even myself as a young trader, would let trades go wildly offside, much more than you reasonably would allow. And then you watch them come all the way back and you take a scratch. You don't even take a profit, you take a scratch. Okay? So this is because people don't like realizing losses. You don't like to see that negative for a start in your P&L account, and you certainly don't like pressing that button to get out for that losing trade. So we end up being much more risky on the downside than we are, aggressively risky on the upside. So if you get a trade on side, okay, you've waited for this trade, you put it on, you're 5, 10 ticks on side, you're much more likely if that comes back towards your entry point to take out for a small profit than you will do if you go offside slightly, okay? You won't just get that out for a small loss. You will let that trade go sometimes to your stop, one tick away from your stop, you'll move your stop, you'll pull your stop, and that trade goes aggressively against you, but you won't cut it instantly. You'll wait and see what happens. There's always that mentality when we're trading, that what if. But we always see it on the downside. We never really see it on the upside. We never say, well, what if this trade, hits, stops on the upside, and we're going to make more money? So we very rarely kind of scale out of profitable trades at the right time or allow them to breathe and to run. But on the downside, for whatever reason, again, it's that fear, okay? And fear plays a big part in people's egos, in people's terms of how they look at trading, how they think they're going to be successful. And it's all balancing the cash risk money management with your own style of trading and your own kind of trading psychology. So when I do my courses and I talk about trading, it always just goes back to the basics of planning. Okay, planning and preparation. This is the only thing that can set you apart from other people. Knowing in advance what you want to do. So having a plan, having a trading plan of your own is very, very important. And the key to having a successful trading plan is implementing the right kind of cash management or money management. The same thing. Your cash is your capital. You have to think that whatever you've got on deposit doesn't just allow you to trade. It allows what size you can trade, how often you can trade. It's your actual currency. And you have to think that you can't just keep topping that up with money if a trade goes against you or you have a few losing days. You know, you have to think that capital you've got is all you've got, and you have to protect it at all costs. So it comes back to being the disciplined trader or the rogue trader. Okay, the aim of trading is ultimately to make money. Okay, which would you rather be? Somebody who's disciplined and can make money in a structured way, or a rogue trader has one big hit or one big loss and you're out of the game. Okay, we're not like people at UBS. We're not like, obviously, Nick Leeson. We're not trading other people's money generally. We're trading our own cash. So you have to think that once that money has gone out of the account, it's never going to come back. So the way we protect that, the way we approach that when we're trading the market, is ultimately what's going to set us apart from other traders. So a simple statement is that if you don't look to make more money on profitable trades than losing trades, in the long run you're doomed to failure. It's the reason to hold on for unsuccessful trades. And I've heard them all, I've seen them all, I've done them all. The number one for me just seems to be fear. Okay, the fear of realizing that actual loss will keep people in a trade for much longer than is necessary, is logical, okay, or it was actually physically going to make you any money. The reason why people have fear is they have poor rules, okay? They don't put stops in place, or they don't know an exit strategy. So an exit strategy is not just as simple as, I've gone offside and out, okay? You don't have to be frightened about going offside. I mean, I'll let you into, again, a secret. I've traded many, many times on FX Street live, and I've gone offside. And I almost, this is my style of trading, I almost prefer to go offside straight away, okay? When you're trading on a spread betting platform, for a start, then you have to understand that when you press that button, you're going to be offside because you're paying the spread. What I like to do is I know the markets get pushed, and I get involved in the extremes. So when you're involved in the extremes, be that outside Bollinger Bands, outside key support and resistance, the market can get squeezed a little bit further, and it's always that little bit quicker and a little bit more aggressive. So what I like to do is start with smaller size and know that I'm going to go offside and buy more at a better price or sell more at a better price in order just to get that last bit of volatility out of the market. So I'll come to that point later on, because I think that in the current market conditions, that rather than having finite stops, which again I still think is a valid way of trading and ultimately controlling cash and risk management, is to start with smaller size and to negative and positively average. But like I said, I'll come to that a little bit later on. Fundamental news. Now this comes back to not being aware and not having good plans in preparation, in ready for the market, trading day and activity. If you're not aware of fundamental news, okay, and you're trading and your trade goes suddenly offside, you should be aware of any of the big US figures, any key speakers. So again, it comes back to that planning and preparation. You should never be trading the first Friday of the month at 1 o'clock, having a long position, because we know that's non-farm payrolls. Okay, so these are just basic things. When you talk about cash and money management and being prepared to deal with market volatility, you have to know all the equations of the game. If you're just trading and don't know the big events are coming out, how can you possibly have a good risk reward? How can you possibly have any kind of risk management? Because as we know, non-farm payroll can move the market quite easily, 40, 50 ticks in a straight line. So how are you going to fade that out? How are you going to deal if you're on the wrong side of that data that's going to shift your market in the opposite way of your trade? And number 4 for me is just having the wrong opinion. And that's going back to the ego. That's going back to the arrogance and the overconfidence some traders can have. Sometimes we're just wrong. Okay? We can all say that, the market's going to go down, or again, the market's right now, like the S&P, the Dow, making record highs. We all know they're going to go down at some point. But that doesn't mean we're going to make money. They can quite easily go up another 300, 400, 500 ticks before they drop, 1,000, 2,000 ticks. But it's being able to judge when it's going to do that. Trading is not just as simple as having the right opinion. Many times you can buy in a bull market and lose money. You can sell in a bear market and lose money. And that's what makes trading so difficult. It's timing. It's timing in being involved with the right size, the right time, and in the right place that makes you the money. Having the right opinion sometimes can be very dangerous in trading. Sometimes it's got to be market neutral and just to buy and sell where you see good opportunities, not to have an overall idea of where the market's going to go, what it could do. You know, being able to get involved in the market in a responsible way rather than just having the right opinion. So, again, comes back to cash management. It's the key. It's understanding what you're trying to achieve, understanding what kind of rules you put in place for yourself. And this can be having tight, finite stops. The market goes from here to here, I get out. Or you can have a trailing stop when you're onside. So the market, you know, you don't take your trade out too early. You just say the market goes back a certain percentage or number of ticks to get out for X amount of profit. Or you don't trade with stops at all. Okay, I don't really recommend that unless you're an experienced trader. But personally, I don't use stops. But again, got a fairly big account, been trading for a long, long time. And as I said, I get involved in the extremes of the market. So what I do is when the market overextends, I trade a lot smaller size than I normally would, and then allow myself to negatively and then positively average in order to filter out that volatility. So as I said, when we talk about risk management, cash management, for me, it's all the same thing. If you have money in your account, you have to have some sort of planning in place to not just manage it, but to make sure you don't lose it. And I think that the whole thing for me when I was a risk manager at Revco kind of opened my eyes. You know, I dealt with some pretty big traders, you know, some pretty substantial traders, and it was always the risk department and the people in risk. It was always a negative thing. It was always when you got a call from me and bad news, you know, you were stopping trading for the day or you'd done something wrong. It doesn't have to be that way. You know, the whole point for me is trading should be enjoyable. You know, if you're not enjoying trading and you're not enjoying being in the moment, then stop trading. It's not for you. You should never be frightened of trading. Okay? You should never be frightened of putting a position on. If you are, then one of two things are happening. Okay? You're generally wrong if you get that bad feeling, or you're trading too big a size. And you probably listen to other people that are going to tell you different things, you know, on this subject of risk management. But it doesn't matter. It doesn't matter because I've been there, I've done it, I've seen it, I've done it for so long. There is no other reason for being afraid. You're either wrong or you're trading too big a size. It's as simple as that. You know, if you put that position on and you've already paid your spread, you think, that's a lot of money. Then you go 1, 2, 3 ticks offside. You know, you're not going to have an enjoyable trade. And ultimately, you're not going to make money. There's absolutely no point in trading too big a size. How you make money in trading is by compounding small, manageable wins versus small, manageable losses, rather than just going for that big one-off trade. Because you might get 2 or 3 big one-off trades in a row, and if you're trading in that way, you're going to lose 20-30% of your capital in one downswing and one down trade, and then your whole mood changes. There's nothing worse than seeing a trader lose the confidence and not being able to get back in the rhythm. So having that right risk management and cash management from the offset sets you in, you know, for the long haul. Trading's, you know, it's a marathon, not a sprint. So you have to make sure that, you know, you're constantly in the markets, and then you can make some money every day and bank it. And when you have a loss, it's not something that wipes you out. So for me, capital is king. As I said earlier, you don't want to be able to be in a position where you're losing, you know, more than 10, 15, 20% of your overall capital, because that, you know, dictates how often you can trade and how much you can trade. Okay, so very much unlike, you know, betting on fixed odds, you can lose more than the initial stake, much more. And we've all been there. When you press the button, sometimes it's almost like it's a magnet. It's a lot easier to get offside than it is onside. How many times you press that button and you trade within 5-10 minutes goes exactly to your exit point? Very rarely. How many times you press that button and the second you press the button, the market goes against you? Happens a lot more regularly. So the other thing I'd like to say about the cash management and the risk side of it, people think that's for other people. They think it's for professional traders. They think it's for somebody who's very mathematical. They think it's somebody else, but it's not. You've got to act like a pro even if you're novice, okay? It's as simple as that. You know, begin as you mean to go on. You know, that's the motto for me. You know, just because you're trading small right now, in 2 years' time, you could be trading fairly big size. So follow the 4 basic steps, which we're going to come to in a minute, and get yourself in the right frame of mind. And again, it just comes back to that planning preparation. If you have 4 steps, then that's not really hard to follow. is it? 4 steps in your trading career to follow for your entries and your exits, and your general attitude to the market is going to help you out much more than you know. And again, you don't have to use them all the time, but the more you use them, the more confidence you're going to get. The more confident you are, the better trader you're going to be. Simple as that. Next point is avoid excuses at all costs. Okay, the market doesn't listen to you. The market doesn't care. So just don't bother about excuses because they're irrelevant. Big one for me again, well, is always the market's not against you. I've heard it all. There's a camera on my shoulder. There's somebody controlling this. Somebody knows what I'm doing. It doesn't. Okay, so the quicker you get that out of your mind, then the easier you're going to sleep at night. The market's not against you. It doesn't know you exist. And it doesn't know I exist. It doesn't care. So we need to get that out of our mindset straight away. Then the last point is really accept you're not going to get the market right all the time. It's an odds game. It's a percentage game. Okay, so some are going to win, some are going to lose. It's like playing poker. It's like playing golf. It's anything. At some time, you're not going to get it right. You're going to do a bad shot, get a bad hand. You're going to get a bad trade, a bad run. Doesn't matter. That is part of trading. Okay, and if you can't accept that, then trading's not for you. It's as simple as that. Got a couple of questions coming through. How can you lose more than your initial stake? Yeah, well, it's spread betting, Pookie. Not seen you for a while. How are you doing? Yes, I mean, if you put, a £5 bet on trading and it goes against your 10 ticks, you're going to lose £50. So that's how you can lose more than the initial stake. I mean, that's the basics of trading. That's why it's not like fixed odds. If you put £5 on a horse to win at 3-1, you know what you're going to win. You're only going to lose that £5. It's as simple as that. Okay, Ian, good to see you. Price attached to my stops by rubber band. Yeah, I mean, again, the whole thing again, Ian, is coming back to people's different preferences. Some people cannot and will not trade without a stop. And again, I admire that. But I don't trade that often, you see. So when I get involved in the market, it's for a reason, because we're at them extremes. So I will, again, like to fade out, that very, very, extreme movement in the market by trading smaller size and using that as almost a stop. Because generally, if you're trading small enough, as you do averaging the right kind of percentage, the right kind of way, eventually we get to a point of break even. Now, you can't just keep doubling obviously like a casino mentality. But if you approach averaging in the right way, you're generally going to get out with some sort of retracement, okay, of your move. So you're either going to be able to get a small loss or a scratch at some point, and that for me acts as a stop. But again, that's just a different way of trading. Again, I respect people that put finite stops in. I respect people that, will do the trade 2 or 3 times before they get it right. But you have to be disciplined, because once you stop that, then the risk-reward ratio goes out the window. Your profit to loss in terms of trades goes out the window, and you never make any money trading. So it's finding out whatever works for you guys. Again, as I said, I've been a trader, for over a decade now, so I know and I'm comfortable how I trade. I've also taught people to trade from scratch. Thousands of people now know how I've taught them to trade. But again, everyone develops their own style. You have to evolve, you have to change with the market, as does your trading approach. The markets don't move in the same way they do all the time. When I started, I could trade the button and it would have a 10-tick range for the day. That doesn't happen these days. Okay, so trading changes, so does the way you approach the markets. Okay, another question or comment here. Well, if you know your targets, you can make money. Yeah, if you know your targets, you can make money. I'll agree with that. Okay, and I don't quite understand yours though, Buki. And FX. Okay, and an FX what? And margin calls. Margin calls are margin calls. Margin calls are based upon the amount you've got deposited. So you shouldn't be getting margin calls because you'd be trading within the amount of money that you have. It's very rarely that, you should be trading your entire account or your entire capital, Buki. Therefore, you shouldn't be getting margin calls unless you're holding big positions overnight, which you shouldn't be doing. Simple as that. I don't hold over my positions, really, because I like to sleep at night. There's enough market movement in a day to make money. With ranges of, between 100, 200, 300 ticks in most markets, why do you even have to hold overnight positions? Yeah, of course you can lose in FX, Boogie. You can lose in any market. Anything that moves, you can be wrong. Therefore, you can lose money. Anyway, 4-step rules for trading. Okay, so this is my kind of the basics of basics when you're trying to put on any trade. You have to know these basic 4 things. So number 1 is preparation. So informed is forewarned. Okay, you have to understand in the preparation what you're trying to achieve. You know, what's happened technically, what's happened fundamentally, and again, what you're trying to get out of the trade. Your entry level, again, don't rush into the trades. You know, the entry is one of the most critical parts of trading. You know, that difference between a couple of ticks being that few seconds too early could mean you're offside, you know, or the momentum's going with you and you're trying to chase the trade. So entry level, you know, it's very important. So again, don't rush it. Your target level, you know, where's the market going to go? Understand where you are in relevance to the trading day. Understand, you know, how far the market has moved on average, the average trading range, the daily range. Understand where it could potentially go, yeah, and how long you have to hold the trade for in order to hit that target. Then your stop level. So your stop level, be it a trailing stop, finite stop, be it, you know, your averaged position, you know, you should have some idea, be it a price or be it a monetary value of where you're going to stop, of where you've just taken on too much risk or you're just wrong, okay? So preparation. For me, again, this is the cornerstone of any kind of trading strategy, okay? It doesn't matter if you're a scalper, position, momentum, a day trader, position trader, okay? Don't just log on and trade, okay? You have to give yourself at least an idea of what's happened, what can happen. Yeah, look at things, simple things. What the currency pairs have done overnight, okay? Check overnight news, big events, you know, big geopolitical events, big fundamental events, you know, again, things like, you know, the recent cyclone, you know, again, exactly how many effects on the Asian market. You just don't know. You know, okay, so read these things, you know, open the news wires. It only takes 5 minutes these days with Twitter, with the availability of online news to filter out the key headlines. So the market's moved as you expected. Remember, the futures markets can't continue trading after the cash markets close. So what happened in those markets, you know, overnight or in late night trading? What data's coming out today? As I said, you should never be trading and get caught out by a big event like non-farm payroll. You should know when the key data is out. Okay, what do you expect to happen today? You know, what's the day's trading got installed? Have you got any understanding of what could happen? You know, if trading technically, are you aware of the technical levels, the targets? You know, again, we're making new highs on the Dow. What's going to happen when we hit 16,000, the S&P, 15,800? What's going to happen around these key round numbers? Then weekend analysis. Okay, this is another big one for me. Once you've traded the week, you know, you should be assessing if you've made money, if you've lost money, and then looking back on how you've done your research and your preparation, and always take a step back when the markets are closed over the weekend and reevaluate these things. And that, for me, is your quiet time. You're generally not going to be holding positions over the weekend, hopefully. So you should have, you know, be able to take a step back and just see what the market, you know, is trying to give you. Okay, just a few more comments coming through. Let me just go through these. Okay, what about swing trading? Okay, well, swing trading again, you can still swing trade intraday. You know, there's still enough market movement to swing trade. Again, if you want to hold overnight trades, then you have to be aware of things like, you know, your margin calls. You have to be aware of, you know, the cost that's involved in holding a trade. You will get charged for holding an overnight position. So you have to understand, again, the market's my gap. You know, not overnight. They might open on a Monday morning significantly higher or lower. So how are you going to deal with that? Okay? All these things you have to understand when you're holding overnight positions. Okay, so Alan's just saying, if you leverage on a Sunday night, euro dollar opens 100 pips higher, for example, you can have a minus balance. Yeah, absolutely. I mean, again, the broker, I think what you have to understand is, you know, if you're letting the broker do things for you, then it's generally because you've lost money or you're trading too big a size. As I said, you know, you shouldn't be putting a position on, okay, and holding overnight or holding over the weekend and expecting the broker to have done anything. You know, the broker shouldn't have to do anything in your account. There are certain limits that are set. But if the market, again, as I said, if you hold a weekend position and you're close to your margin call, and then the market opens, which you can do regularly, you know, 100 ticks or 100 ticks higher or lower, then again, you're going to be automatically taking out your trade and then left with a minus balance because all your margin has been used because you've gone offside. So, I mean, it's not that difficult to understand, is it? Okay, if you're trading in the normal constraints of the day and the market moves between 50 and 100 ticks, you know that every time you write, you know, whatever you've staked, you know, when you're right in that direction, the market gives you another amount of your stake. Well, if the market closes okay, at a certain point, and you're still in that position, if it opens 100 ticks from where you are now in your direction, and if you're buying it opens higher, then you're going to make that money. But conversely, if it opens 100 ticks lower, then that's just like if the markets were open, it's just like going 100 ticks offside, 100 ticks against you. So that's how you can end up with negative balance. I mean, you have to take responsibility. If you're trading overnight and you don't understand these things, A, you shouldn't be trading overnight, and B, you shouldn't be trading at all, to be honest. There's no excuse for not understanding. Trading isn't that difficult. Okay, you're buying or selling a market. As it goes up, if you're buying it, you make your stake per point. If it goes down against you when you're buying it, you lose that stake per point. So if a market changes overnight, in big chunks, which it can do, then it's just the same as being offside when the market is open. Okay? No, it's not that difficult to understand, really. Gaps are gaps. You can use them in your favour, but you can't do anything about a gap. The gaps, the markets can even gap when they're trading, when they're in open market sessions. Okay, we can gap prices out. But gap pricing happens because new information has come into the market and the perception of the perceived value of your commodity, your security has changed to whatever tune. So the market is now trading higher or lower. And if you're on the wrong side of that, then it's just the same as being offside in normal market trading conditions. So that's just the way it goes. So going back to weekend analysis. So as I said, the whole point that I like about weekend analysis is the markets are closed, so you can't do anything. So if the market is going to gap and there is, huge, again, say there's a terrorist attack on a Saturday afternoon and you're long the S&P. Well, on Monday morning when that market opens, you're in trouble because the market's going to go down. So what are you going to do about that? Okay? Well, not a great deal you can do. If you've longed the market. But what you have to understand is when the market opens again, people will have had time to digest it. So the markets will bounce. It will bounce up. It will then continue down. And people will find value and it will go back up. So, yes, weekend and holding trades holding trades overnight is a very good way to extend your profits and make good money. But the risk is exactly mirrored. If you get it wrong, the markets can move very, very quickly against you. So if you're not running overnight positions, as I said, it's a good opportunity to take stock. Look back at what's happened in the fundamentals, what's happening in your own trading, and then see if your plan's working. Okay, if your plan isn't working, then maybe try something different. Then again, plan the week ahead. Get your economic calendars open, see the data releases, central bank speeches, anything else that might shape the trading week. Again, another thing, as I said, people generally get caught in a bullish or bearish stance, which means they can't see the proper opportunities. Sometimes the best way to trade a market is to do the opposite of what other people are doing. See, many a times when you've watched me trade live, the last FOMC I did, gold dropped about 200 points in about 5 minutes after the FOMC, and I bought gold at the bottom, and we made 50 ticks in the space of 35 seconds. So I still made good money, even going against what everyone else was doing. Everyone else was selling it, but I saw a good level, a good value point to buy back, and we came back and made some good money. So you don't always have to go with the crowd, follow the herd. You can go against it and still make money. But again, it's understanding how you want to be involved in the market. Okay, that's what's going to help you risk reward. So again, be firm in your opinions about life flexibility, and again, every figure can be different, so don't treat them all the same. A non-farm payroll is more important than a CPI PPI. So make sure you trade the right type of figures, the economic conditions. Okay, we're not letting this go, are we? What happens if a gap goes over a stop? Well, you can either have guaranteed stops, okay? So you set guaranteed stops in InterTrade, and they'll stop you at the price you give. But if you haven't got guaranteed stops, then your trade is subject to market gaps. So if you're subject to market gaps, the market gaps, then you get out for whatever your margin requirement is. So it'll just take all the money in your account and get you out, whatever the market's trading at. So you have to read these things before you open your spread betting account or you trade. You can have guaranteed stops, which get you out for what you've guaranteed, but you pay a premium for that. Or if you just trade normal market conditions and overnight, you trade is subject to gaps. Okay? So entry level. So depending on your style of trading, looking at your entry level can let you preempt market moves. Okay? So this might be kind of more dynamic or predictable, but knowing that when a market reaches a certain price can give you an edge. Okay? And what do you do now? So again, think about what the market might do in response to a certain figure. You need to go with the price action or get into the retracement. Again, a lot of people think it's fastest finger first when we talk about trading these days. I don't think you have to be price specific anymore. You don't have to get in at a price in order to make money. And that's why, again, I like the kind of smaller size and averaging. I like to trade over a number of prices to kind of filter out the noise. And I like to do the same with trading figures. Okay? If you try and hit a non-farm payroll figure at market, it's very, very unlikely you're going to get the actual market price. So much is happening just after that figure's released that it's more beneficial for me to let the first 5 minutes of trading happening, and to be in the market and to see and let that volatility slow down, and then trade the continuation, trade the retracement. Okay, and then you understand that you're getting much more accurate market prices. Market can blip up 20, 30 ticks in a matter of seconds just after non-farm payrolls. So your entry level, for me, especially when you're trading off a spread betting platform, you're never going to get the price you want anyway because you're always paying the spread. So, why would you look to get involved in one single price? It's a bit too finite for me. It's a bit too exact. So I like to trade smaller size and trade over 1, 2, 3, 5, 10 prices in order to get an average. And I'm not too fussed about an individual price. Okay, I can average over a number of prices. Okay, and that gives me a better opportunity to set a good stop because I'm fading out that quick volatility. So target levels. A lot of people, again, always focus on risk management, cash management, about what they're going to do if they're wrong. As I said, the whole point of risk management is not to be negative. Look at the positives. You're getting in a trade, you're putting a trade on because you want to make money. So why do you always focus on where you want to get out? Well, you have to because it's prudent. But on the other side, you have to know where you're going to go out for profit. So what you're aiming to achieve out of the trade, okay? The market might be primed for a big move, or is it just a fake out? Is it a sucker move? So looking for a big move, then what you're looking for, what key things will tell you it's a big move? It'll be that volatility, it'll be that volume. So you'll see big green or big red candles. You'll see key levels, being broken, rather than bounced off. So when I talk about bob levels, break or bounce, if you see a level of resistance, if that doesn't bounce back to fair value and it breaks through, then again, that's telling you we're ready for a big move. Also, don't be greedy. If you've got the back, if you've got the back of a big move, then take some profit out. There's no point leaving money on the table. And that again is to do with scaling. So take half your profit out at your original target point and let the rest run. Then set a trailing stop. All these things will help you make more money in the long run. Okay? You're never just going to get from offside to onside exactly to your exit point and take out the maximum amount of money. It just doesn't happen that way in trading. So make sure when you trade onside, you're banking money. This gives you more money in your account and it gives you confidence. And it's just a good exercise and a good routine to be in. Don't leave too much money. And again, plenty of time I've heard traders say, well, I've just held on. I would have made more money. I would have done this. I would have done that. The whole point is about trading is about being right. So if you're right and you've got money in a trade, take some out, leave some in. Okay. If you get into the routine of constantly banking some sort of profit, then you're going to go much, much further in trading. Okay. So when you set a target as well, stick to it. Okay, so like I said, you can take some profit out, but then try and let your target be hit because you don't know. The market is going to overextend. The likelihood is your exit point is going to be the next trigger. So the market, if it hits that, it's going to go further. So that's what we have to let happen. And that just moves on to the next point. The market will generally push further, when your trades are onside because, you're going with the market direction. You're going with the momentum, the volatility. So when the market starts to blip up and blip down and you're long and short, then that's why I say you have to be getting out at your exit point. But if the market continues, then there's nothing wrong with getting back into the trade. Okay, just because you think it's going to go 40 ticks doesn't mean the market can't overextend to 80 ticks or 100 ticks. So there's nothing to stop you once you've made a trade getting back in at your exit point as an entry. And then again, we'll come on to the classic excuse of not taking profits, not being stopped out. I wish I'd done this. But all the other things I've heard over the years. Okay, I've heard every excuse you could ever say for people being onside, not banking profit and taking a loss. People taking, too many losses and then, taking a scratch on a winning trade. like I said, you just have to avoid excuses. Nobody's watching you. Nobody cares. Nobody's interested in it, okay? You have to just take responsibility for your own involvement in the market, okay? Trading it's difficult. It's difficult, and there's emotion attached to it, and there's all these different things. But the more you take responsibility for your own plan, responsibility for your own cash management, you should never be sat there and thinking, do you know what? I knew I should have taken that trade out. Now I'm 20% down in my account. It gave me 2 opportunities to scratch it out, and I didn't. Why didn't I? If you find yourself saying these things, you have to, again, understand these are your rules. It's your trading account. You set these things. Why are you not sticking to them? Why are you not doing what you said in your plan? It's not homework. It's not like the teacher's going to tell you off. It's your money. It's your plan. It's your trading account, your trading career. So if you do things in this manner, you've only got yourself to blame. I know it sounds harsh, but it's true. So your stop level. So this is the big one, okay? So where should this be? Okay, so really for me it should be the first of the 4 rules. Now, it's easy to look at the markets and think, what it's going to do. But what happens if you're wrong? This is the most difficult thing I find to teach people in trading, okay? Because it just seems to me that people think that trading is black and white. Trading is not black and white. It's a whole different grayscale. As I said, you can lose money buying a market as it's going up. You can lose money selling a market when it's going down. Okay? It's not necessarily your analysis is wrong. It's not necessarily that you're wrong. It's the timing. And it's the timing in conjunction with the size. Okay? You can predict a 100-tick move, but if you're trading too big a size for your account, that can go down 5 ticks, and that's taking the confidence, taking your stop into account, and you're out, and then the trade goes 100 ticks on side. And yes, you'll say, I would have made this, I would have done that. Okay, there's no prizes in trading for using big size. Okay, everyone thinks that you have to be using all the margin available to you at all times. Everyone thinks the way to get rich quick is to trade big size. It's not. The way to get rich in trading is to make a number of compounded, smaller winning trades, and to be right more often than you're wrong. Okay? And you can disagree with me all you like. Okay? It doesn't make any difference to me. I've seen more traders, I've taught more traders, I've done more things in trading than the majority of people can shake a stick at. So, it doesn't matter. Okay? I've tried everything. Okay? When I first started trading, I thought I knew everything. So I was trading big, massive size in the DAX. I was letting trades go massively offside. I was trading with 4 figures, trying everything. I thought I knew everything, and I did. And it took a long time. It took about 4 years to understand really what my trading style was. Didn't mean I didn't make money, but it wasn't controlled. You can have a £10,000 up day, £20,000 down day. Sounds great. Sounds very exciting. It's not. Okay? It's not exciting. It's not professional. It's not the way you should approach trading. You should approach trading by being able to make a sustainable amount of money consistently, day in, day out, week in, week out. And it saves you a lot of stress, and generally you make a lot more money because you're trading less, you're ensuring less costs, and you're much more controlled. So again, your stop level, again for me, all just reiterate around that what you're trying to achieve versus what you're willing to risk. It needs to be a good risk reward. So that just comes back to, I'll just use a quick example of betting. I don't like using, even though we call it spread betting, I don't like using betting terminology, but this is one of the nicest ways of putting it, okay? So when we talk about risk reward, think of this. If you bet £10 on a dead cert horse, so I say, I own a horse, it's going to win the next race, okay? So if you put £10 on, at the odds of 10 to 1, I think you think, right, that's a very, very good bet. Put £10 on, get £100 back. So if I say it's 3 to 1, well, it's less exciting, but you'd still back a 3 to 1 winner, guaranteed. Okay, what about 1 to 3? Okay, not quite as exciting, is it? Well, so would you bet £3 to get £1 back? No, you wouldn't. Not so enticing. So why would you do the same in trading? Think about that 10 to 1, 3 to 1 as trading ratios. So think about, would you put £1,000 on, okay, with a stop loss of £3,000 if you're only trying to make £1,000? So you're putting your trade on, you're trying to make £1,000. Would you put your stop loss or will you get out at £3,000? No, you wouldn't. You're looking for that to be the other way around. So surely you want to invest £1,000 to make £3,000, okay, or use the right kind of ratio, the right kind of stake, that in order you're going to make £3,000 on your trade based upon your stake rather than lose £1,000. Now, people keep asking me, what the kind of risk or ratio is, and again, The basic one that generally any website or any trading educator will tell you is that use 1% of your capital. So 1% of your capital should be your stop. You shouldn't ever really be, losing more than 1% of your capital on any single individual trade. I personally don't think that's true. Okay? So when we talk about risk-reward ratios, I'm generally thinking the rule of thumb is 1 to 2. So risk 1,000 to make 2,000, or risk 100 to make 200. Translate that into trading terms. You're trying to make 60 ticks, then you want to put your stop loss 20, 30 pips from your entry price. Okay? That makes sense. For me, I don't trade every day. I don't trade all the time. So my risk-reward ratio changes. Okay? I'm happy to risk anywhere between 10 and 25% of my account value on any one trade. And that's because, again, I don't put it all at one price. I put smaller increments of size in at different prices. That means that I'm taking the same kind of overall risk, but I'm spreading it over prices. So when it goes in my favor, I can hold trades longer and I can make more money. Okay, so it isn't as black and white of just saying that if you only ever risk 1% of your capital, then you're only going to lose X amount of money and you're going to stay in the game longer. That is true. But if you've waited for trades, you're not going to make as much money on the profitable trades, are you? So again, it's that balancing act. Maybe trade 3% of your capital on big figures, but only with a finite range, a tight range of that figure. If non-farm payroll is expected 100,000, don't buy it unless it's above 130. Don't sell it if it's below 70. Don't trade it if it comes out 101. Okay? And that, by doing this and setting things out the right way, you can use more of your capital on the good opportunities. But again, if you don't have a plan and you don't have any kind of cash and risk management, then you kind of frightened into trading 1% of your capital because you don't know anything else. You don't know any other way to trade. You don't know what's a good opportunity, what's a bad opportunity, apart from the money it made you. So for me, by looking at things as I do, with my trading, getting involved in the extremes of the market. If I know gold's gone down 250 points in 3 red hourly candles, I know it has to retrace. So I'm happy to trade and buy, even though the market's going down, smaller and smaller amounts, into that bottom of the market to let it retrace. And I know the odds are in my favor that it has to retrace at some point. I'm going to make some money. So maybe I, average in 2% of my account. It goes a little bit further down, 4% further down, 8%. I could get all the way up to 25%. But by the time I'm buying more and bigger size towards the bottom of the market, as it comes back, I've got the opportunity to scratch. Or as it bounces back up, make some profit. Okay? But again, that's just my style. I understand my risk reward. I understand what I use my capital for. And so do you. If you don't understand it, then you're not going to be able to do these things. So as I said, the key for me in these current market conditions, especially when entering the market, is to start small. Start with a one lot. Start with, a pound, whatever the minimum stake is. You can always put more in. Okay? Generally when you're offside and you're taking money out, it'll either be for a profit or a loss. But as you do that, your size becomes smaller. The benefit of starting small is you can always go higher. You can always use more margin. It doesn't work the other way. So for me, the volatility is good because it allows me to make, more money more quickly because of the market retracements and the market extensions. And again, with being able to average and being able to use my own cash and risk management in that way, then I don't actually have to use stocks. But again, as I've shown you, there's different ways of trading. So as I said, why beginners lose money, again, I've kind of gone over this really. It's really because, they don't have a plan in place. So they'd rather see a position go 100 ticks offside and take a 20-tick profit or even a scratch. So as I said, we've all been guilty of this. We've all done this in our trading careers, but it's not sustainable. You can't let trades go wildly against you. So that's where your risk management has to come into play. You have to know when to stop, when it's wrong. So why use stops? Well, again, as I said, if you're talking about the basics of cash management, then it's to protect your capital, okay? They're not always rational. They can over-exaggerate. So as long as you've got a fixed stop in place you can afford, you know how much money you're going to lose in a trade. And that could be the only way some people can trade. But as I said, as I pointed out, it's not the only way. So if you know how much you're going to lose before you put the trade on, well, really, you're right. If you can afford that loss, then you've never really gone out of your risk-reward parameters, okay? So again, when the market goes against you and you get stopped out, that doesn't matter. You can always get back into a trade. There's always more than one opportunity to make money out of any move. And then stops allow you to take a step back. And if you are on side, Okay, you can walk away from your screen. Or you can take take a bit of a deep breath. Once that stops in place, you know you're rich, you know you're out, and all you've got to focus on then is the upside, what's exit. So as I said, avoid excuses. Okay, I got stopped out. The market went exactly where I was going as I got stopped out. Again, from trader talk, from being a risk manager, that translates into my entry level was wrong and I misjudged where the market might go first. We've all done that. Or placed a position that was too big for me, or too big for me to handle. I got frightened of being offside amount of money, so I got out. Okay? That's the two reasons why people lose money in trading, as I said at the start of the presentation. So the art of trading is judging where the market might go beforehand, before it hits your target. So you've got to adjust your size accordingly. So for me, it's all about using the right kind of size at the right kind of time. So to conserve money in volatile markets, well, that's what we're in. Okay, keep to your rules. Pick a time of day to trade. Don't trade the opens, I would say. Okay, use stops if you want to. Negative, positive, average, manage your size. These are the 5 things we need to look at. Okay, so have your trading rules in front of simple as they should be written down. Make sure it takes into account what you've got on capital, because that will dictate your trade size and frequency. And understand the market conditions and how it can change. If you're trading a market that's highly volatile, you have to understand where it can go to. Time of day, trading UK markets, again, understand that it's going to slow down in the afternoon until the US market's open. These are basics we have to understand. When we understand how volatile a market can be, how volatile our position can be, they'll affect our cash, our balance. You have to understand these rules. Again, are you a morning or afternoon person? What time of, periods are you trading? These things can affect your attitude to risk. Use stops. Again, if you want to, if you're trying to make 100 ticks, then, to make 15 ticks, you've got to risk 5. To make 100 ticks, you've got to risk 30. Keep it realistic. You're not going to be able to make 100 ticks, consistently with a 5-tick stop. Okay? You're just not going to. Yeah? If you're looking for the smaller moves, the scalping moves, have a small, stop in place. Looking for the bigger moves, again, start with smaller size, build into positions, or give yourself a wider stop. Okay? You're never going to get the perfect entry point. And again, you might make 100 ticks out of a trade, but if you've had a 30-tick stop and you've lost that, then you make 100 ticks. Then in reality, if you've lost 3 trades in a row, you've only made 10 ticks. So keep it balanced, keep it in the sphere of what you're trying to achieve. Again, common term, I always get stopped out of trade, and that's danger entry point. Okay, your stop's too close, or you're trading too big a size. And as I've said, the way to stop getting stopped out all the time is to trade smaller size, and then use wider stops or no stops, and then average. Okay? Averaging for me is the way you trade volatile markets at the minute. So negative average, when the trade goes against you, you buy more at a higher price, you sell more at a lower price. Positive average, that's when you trade on side. So if you buy in the market, you buy more as the market goes up, or you're selling it, you sell more as the market goes down. Simple as. Okay, manage size. Okay, know when to use the right kind of size. Simple as that. I mean, it's smaller positions allow you to go bigger positions. You can run smaller positions longer. Okay, all these things are psychological as well. If you trade smaller size, you'd be amazed how many people can let a 1-lot trade go 50 ticks and not bother. How many people can let a 50-lot go 50 ticks? Not many. Okay, so use the size that's appropriate to you and for your right style of trading, and also for what you're trying to achieve. Okay, if you're trying to make big money, you've got to put on bigger size. If you're just trying to make consistent good money, your size doesn't really matter. You can still make enough ticks in the markets these days with relatively small size, and again, compound them smaller wins in order to, again, build up your account. So conclusion really is risk management is the art of balancing profit expectations versus manage your losses. Don't always concentrate on the negative with risk management. It is to do with your stop, but it's also for your exit point. Okay, don't expect to get the market right all the time. Simply won't happen. Remember, the market's not against you. Doesn't care, doesn't know you exist. So don't ever take it personally. When you do take a loss, you press the button to get out. Try and keep it as small as you can. Okay, it sounds obvious, sounds easy. I know it's not, but try and keep it as small as you can. Try and let your profits run, and try and cut your losses as quickly as you can. You generally get that feeling that you're wrong. Okay, if a trade goes on side and goes offside, back to scratch, offside. The more it does that, the more likely you are to be wrong. So make sure you cut that as quick as you can, and then reaffirm your opinions, reaffirm kind of trading strategy. You're generally looking to make 7 out of 10 winning trades, okay? But the 3 losing trades sounds obvious, but, you know, again, you've got to reiterate it. Your 3 losing trades can't be the same size as your 7 winning trades, okay? It's all about surviving. It's all about the longevity of trading. So there's no point in making £1,000 in your winning trade than having 3 losing trades of £300, okay? Because with costs and with time involved, you're just never going to make any money. Okay, guys, so that's pretty much the end of my take on cash, on risk management, on ratios. Got a few things kind of we'll quickly go through. I know we're running out of time. Right. Okay, yeah, okay, well, we're going to, instead of stops and losing, is it better to hedge, take advantage of retracement to lower loss? That's a good question, yeah, from DZ Beaster. Yeah, absolutely. I mean, you can hedge. That's fine. But I mean, obviously, there's a risk involved in hedging. Hedging, costs money, and you have to have something that's an inverse or direct correlation to the market you're trading. So again, it's maybe a good idea to hedge when you're trading currency pairs. Because you can get the coefficients and you can understand the strong coefficients and the weak coefficients. That should positively and negatively act together. So yes, that hedging is. But then the more you hedge, the more capital you're going to use. It's an interesting one. To be honest, I wouldn't, unless you're trading really big size, the whole point is you don't need to hedge. You shouldn't have to hedge. You should be trading the right kind of size so you can have a position on and be right or wrong. Unless you're trading tens of thousands of pounds at a time, you don't really need to hedge. And, that's a fact. There's enough money in the market, there's enough movement in the market to trade a normal size and make money. So you shouldn't really have to hedge. But yes, it's a valid point. You can use hedging to give yourself some security. Yeah, well, exactly. Hedging doesn't work in sideways markets. That's a good point. All right, guys. Well, that's pretty much the time. I'm sorry, I kind of we got into a few questions there on the actual mechanics of trading. Kind of took me on a side tangent. But any thoughts or questions, guys? Just get me at Steve Ruffley on Twitter. That's the best way to interact with me. This is really, kind of, for me, the best way of trading. Understanding what you're trying to achieve, understanding how much money you've got on deposit, how you want to use it, what you want to achieve. And if you're getting stopped out too often, trade smaller size and average over more prices. That's the only way you can trade these volatile markets for me in the current conditions. But we're doing plenty more on FX Street. I'll show you how to do this live. We'll do some more live trading, so stick with me. All right, guys. Thanks to FX Street, Maud, Vicky, and the guys, and I'll see you all very soon. Okay, guys. Thank you.